Welcome to the deep dive. Today, we're plunging into a really fascinating report. It gives us a unique window, doesn't it, into a company juggling, well, several dynamic industries all at once.
Yeah, you've got cannabis, beverages, wellness. It's quite the mix.
Exactly. We're talking Tilray Brands and specifically their fourth quarter and fiscal year 2025 results reported July 28th. Now, this press release, it's dense. Lots of numbers.
Absolutely packed.
Right. So our mission today is to kind of cut through that, bypass the jargon, the sheer volume, and pull out what really matters. What do these numbers actually mean for Tilray's strategy, in the markets they're in?
It's a great focus because looking at these results for the year ending May 31st, 2025, it's more than just financials. It's like a case study unfolding, right? Showing how strategic choices play out.
So what's the big picture you're seeing right off the bat?
Well, the immediate thing is this isn't just about growth for growth's sake. You see these strategic decisions really shaping the numbers, even the top line. It tells a story about priorities. For you listening, it's about decoding that story.
Okay, let's unpack that. Fiscal year 2025 highlights. They reported net revenue of $821 million, $834 million in constant currency. That's a record year for them, revenue-wise.
It is, yeah, a record. But like I said, there's a catch, or rather, context. They explicitly state that strategic decisions impacted revenue by $35 million.
Right. That jumped out at me, too. $35 million isn't small change.
Exactly. It suggests they consciously chose not to pursue certain sales, maybe lower margin stuff. They decided profitability or maybe market positioning was more important in those cases.
So less revenue, but potentially a healthier business decision.
Precisely. It can be a strategic win. It points to a focus on, resilience and long-term value over just chasing volume.
Yeah, playing the long game. And that seems to echo in their adjusted EBITDA figures, too. Q4 consolidated adjusted EBITDA, second highest ever for them.
Yeah, it does suggest operational strength, definitely. For the full fiscal year, the adjusted EBITDA was $55.0 million.
Which is slightly down from the $60.5 million the year before.
It is slightly down.
Yeah.
But adjusted EBITDA, it's a metric folks watch closely. It strips out certain non-cash items, taxes, depreciation. It gives a clearer view of core operational profitability. How well are they actually generating cash from the business? And $55 million is still a solid number.
Got it. Now, one area that always seems to have twists and turns in these reports is cannabis. And Tilray's division. Well, there's a lot going on.
Absolutely. It's a tale of two markets almost.
Okay, lay it out for us. International cannabis first. That looks strong.
Very strong. A 71% jump in Q4 revenue year over year, 19% for the full fiscal year. And get this, if you exclude Australia, European cannabis revenue grew by 112%.
Wow. 112%.
Yeah, they're clearly betting big on future growth there. Europe, Middle East, India, Turkey, Asia, they see huge potential. And it's not just cannabis. They're looking at non-alcoholic beer, hemp foods, too, in those regions, positioning for regulatory changes.
Interesting. So a broader international play. But back to cannabis profitability, because that was another key point.
Right. Global cannabis gross margin. It increased by about 700 basis points. That's a 7% improvement for the fiscal year, which is significant.
How they manage that, especially with market pressures.
Well, it goes back to strategy. They focused on preserving margins, keeping average selling prices higher, especially in growing categories like vapes and infused pre-rolls. They even paused sales sometimes if the profitability wasn't right.
Pause sales.
Really? Yeah. And crucially, they shifted inventory. They redirected stock to international markets where the margins are just better. It's smart inventory management. Less about just volume, more about value.
Right. Sell it where it makes the most sense financially. Meanwhile, in Canada, their home turf.
Still number one by revenue for the fiscal year. So even with those strategic tweaks, they maintained leadership there.
And they're planning more. Mentioned phase 2 of an accelerated growth plan, boosting cultivation.
Yeah, it seems like they're gearing up for more demand, both internationally and potentially domestically, wanting to enhance that global supply chain. They're not standing still.
Okay, let's shift gears a bit. Beverages. That also saw significant growth, didn't it?
It did. 19% revenue growth for the fiscal year, hitting $241 million.
That's substantial. And how did they achieve that in such a competitive space?
Acquisitions were key. Remember, they bought those 4 craft beer brands from Molson Coors, Hop Valley, Terrapin, Revolver, Atwater.
Ah, right. That significantly beefed up their U.S. beer footprint.
Totally. Gave them market leadership in places like Portland and Georgia, and they launched Project 420 to integrate these brands.
Project 420, catchy. How's that going?
Pretty well, it seems. They've already hit $24 million in annualized cost savings. Their target is $33 million. So rapid integration, pretty effective.
Okay. And beyond beer, they're pushing into those newer categories too, right? The Delta-9 THC drinks.
Absolutely. They're leveraging that craft beer distribution network they now have. They're in 13 states, 1,300 distribution points. They're positioning themselves as a major player in that whole hemp-derived beverage space, really leaning into it.
It's a fast-moving area. Makes sense they'd want to be at the forefront. What about the other segments, wellness and distribution? Quick summary there.
Yeah, quickly. Tilray Wellness saw a 9% revenue growth, reaching $60 million for the year. Distribution revenue climbed to $271.2 million.
And the margins?
A bit of a mixed bag. Beverage gross margin actually dipped from 44% to 39%. That's mainly due to the lower margins of those newly acquired craft brands.
Okay, that makes sense. Integration takes time.
Right. But wellness gross margin improved, up to 32%. Distribution margin held steady at 11%. So you see that diversification playing out in the profitability profile, too.
Okay, so zooming out from the segments, what about the overall financial foundation? All this expansion, acquisitions, it requires a solid base, right?
It absolutely does. And they made a point of highlighting their balance sheet strength. They have $256 million available in cash and marketable securities.
It's a flexibility.
Exactly, and they've been paying down debt, about $100 million in total repayments so far. That financial flexibility is crucial for future moves, more M&A, organic growth, or just navigating market uncertainty.
Now, something else that caught my eye, moving beyond the usual financial metrics, was their AI strategy. It's not always something you see detailed in these reports.
No, it's quite forward-looking and potentially very impactful. They're using AI specifically in cultivation. Think advanced horticulture automation tech.
How does that work practically?
Well, essentially, they're using AI combined with sensors and automation to manage greenhouse conditions, light, water, nutrients, temperature in real time, continuously optimized.
For better yields and lower costs.
Exactly. More efficient operations, increased output, potentially higher quality, and crucially reduced costs for things like labor, water, energy. In a sector where cultivation costs are a huge factor.
That could be a serious competitive advantage.
It really could. Using technology to fundamentally lower your cost basis while others might be struggling with rising costs, that's, playing the long game with the technological edge.
Okay, so lots of strategic moves, operational improvements, but then we hit this big number, the net loss. It looks, well, huge on paper, $1.27 billion in Q4, $2.18 billion for the fiscal year. What's going on there?
Yeah, that number definitely makes you pause. $2.18 billion loss. It sounds alarming. But, and this is absolutely critical for you listening to understand.
That's not what it seems.
Pretty much. The report states clearly, almost all of which is a result of non-cash expenses.
Non-cash. Okay, break that down.
The main driver is a massive non-cash impairment charge. $1.4 billion in Q4, nearly $2.1 billion for the full year. This relates to goodwill and intangible assets.
Goodwill. Like the premium paid in an acquisition.
Exactly, from the big Aphria and Tilray merger back in 2021. Essentially, accounting rules require companies to reassess the value of these intangible assets, things like brand value, licenses, stuff you can't physically touch.
And they decided they were worth less now.
Correct. Market conditions have changed since 2021. Back then, expectations around U.S. cannabis legalization, for example, were much higher, boosting valuations. Now, the market reality is different, so they have to adjust the value on the books.
So it's an accounting adjustment reflecting changed market views, not actual cash flowing out the door.
Precisely. It's a paper loss reflecting a revaluation of assets acquired years ago. It doesn't impact their current cash balance or day-to-day operations in the same way an operating loss would. Understanding that distinction is vital.
Absolutely crucial context. Okay, so putting that non-cash loss aside for a moment.
Yeah.
What do they expect going forward? What's the guidance for fiscal year 2026?
Right. Despite that big impairment charge, their outlook is actually positive. They're guiding for fiscal year 2026 adjusted EBITDA to be between $62 million and $72 million.
Okay, and how does that compare to the $55 million they just reported for 2025?
It represents growth of 13% to 31%. So they're projecting a solid increase in operational profitability.
Which signals confidence, right? Or in their strategy paying off.
Exactly. It tells you they believe the focus on international growth, the beverage acquisitions, the cost savings, the operational refinements, they expect all that to drive better results moving forward.
So wrapping this up, what really emerges from digging into this report is, well, it feels like a company that's maturing maybe. balancing that strategic growth international cannabis beverages with a real hard focus on profitability.
Yeah, improving those cannabis margins, locking in cost savings, it's sophisticated.
So hopefully, you listening now have a clearer picture of how a company like Tilray navigates these really complex, fast-changing industries, making choices that, prioritize long-term health, not just the top-line number today.
Absolutely. And maybe a final thought to leave you with. This deep dive shows Tilray pushing hard on international expansion, using AI in cultivation, innovating in beverages here in the U.S. It really raises a broader question, doesn't it? How much will things like shifting global cannabis regulations or continued innovation in these alternative drinks categories, how much will that ultimately shape the future for companies like Tilray? What elements of their strategy really stand out to you now? It's worth thinking about what else you might want to deep dive into next time you look at a company report.